I think you're right to point out too that most of the commentary I think is focused on the idea that the U.S. is going to have to raise the rates to match the level that other countries are imposing us. I think a more optimistic, perhaps realistic case may be that other countries decide to reduce their tariff barriers. I think that's a potential for upside surprise that day. And if we can expand market access for some U.S. companies in the process, I think that's going to be encouraging. But even just knowing what the rates are going to be announced at, I think will provide some at least additional certainty, hopefully moving forward. I think that watch is what that effective date is going to be. It's possible that they could take effect, April 2nd. It's possible that there could be additional time to allow some of these negotiations to move forward. In my opinion, I think I would place more, maybe I'm just being optimistic, hope that other countries will reduce their barriers as opposed to us necessarily having to raise ours to their level.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
Welcome to RenMac Off Script. We're able to discuss markets, economic policy, history, and life. It is the 21st of March, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pally.
As a reminder, most of the charts that we reference are posted to our Twitter account at RenMac LLC. You can sign up for our YouTube channel as well, be a subscriber. And we're trying out this new video, and you're going to see, hopefully, the new video if we've done this correctly. Sound like Harry. If we have one thing today and this morning, it is after the first round of NCAA tournament play in the RenMac pool, where we have over 100 participants. Congratulations to David Larrick for picking 15 of the 16 games correctly yesterday. Plenty of time to end up at the bottom of the list. So good luck to you today as well. A lot to talk about. The one thing that, I don't know if you guys saw it, but the one thing that really jumped out to me this week, well, it was just a nice moment, was the astronauts coming home. What were they up there for? 9 months? Supposed to be like a week and 9 months. Now, I've heard that Biden could have done it, but he didn't want to do it for political reasons. I don't know if that's true or not. He didn't want to give the credit to Musk. That seems a little far-fetched to me. But I will say, and I thought, and I'd love to get your guys' opinion on this, I didn't feel like they were giving Musk any kudos to getting these guys back. It was kind of like, where he falls now with the Doge and the controversy is, I didn't hear it from the nightly news. I didn't hear anybody mention SpaceX or Musk having been an integral part, to say the least, of bringing these guys back. Did I miss that?
I didn't see anything. I didn't know about it until you just mentioned it, to be honest.
Yeah, it was. I thought it was. Look, you can be biased in your reporting. You can also be biased in what you don't report too. And I just thought it was, frankly, a little shameful that they didn't give him props on that. Well, let's talk about Putin and what's going on in not only DC, obviously, but around the world, and Ukraine, and these phone conversations. Where are we coming down? Any progress? Bunch of bluster. How do you see this, Steve?
I think what you have is sort of a Russian Rorschach test based on your views of Trump. I mean, if you're somebody who doesn't like Trump, you're going to point to the fact that Putin made very few, any concessions requested. If you're somebody who likes President Trump, you're going to point to the fact that Trump didn't give any concessions to Putin, and that, starting with this sort of agreement to not bomb energy products is, or energy targets, is probably, hopefully, some low-hanging fruit, but the opportunity to sort of expand that, moving forward, probably interest of both Ukraine and Russia to target their respective energy targets. So I would just say, look, talking's better than not talking. Hopefully, things will continue to progress just for the sake of humanity. I'd be surprised if Trump's not talking to Putin about things other than Ukraine. I know it was sort of mentioned the idea that the U.S. and Russia are playing some hockey game, but I guess where I'm going there is you also have some tension in the Middle East, presuming with Israel and Hamas, and I'd be surprised if Trump's not talking to Putin about Russia's support for Iran, and maybe look for him to pull back there in the event that Israel might need to continue to defend itself and escalate the conflict there. That Russia is not going to aid Iran, which aids both Hamas and also the Houthis, now that the U.S. is attacking them, another proxy group backed by Iran. So, if you see the potential for Iranian oil coming off, maybe that's the opportunity to increase supply from Russian oil. Doctor in Saudi Arabia, maybe get them to kick in for any lost Iranian supply. Speculation on my part, but they're talking for close to 2 hours, and I'd be surprised if things like that didn't come up.
Yeah, certainly it's a tangled web to say the least. Where are we?
I would just add, there's been a lot of more optimism, I think, with respect to Europe in their defense spending. And I think that's sort of related to this conflict in Ukraine as well. The idea that Europe's going to be asked more moving forward, I think, to shoulder the burden of defending their interests. And I think it's from their standpoint, you could point to criticisms, both from you think the Trump administration is necessarily going to come to your defense. You look at sort of some of the criticisms from the Biden administration, withdrawing from Afghanistan, holding aid for Israel, which has been an ally. So it's not an irrational conclusion for Europe just to reach that you can't really rely on the U.S. regardless of which party is in power there. And so if they're going to take efforts to bolster their own defenses, it's going to take time. So I think they're probably going to have to rely on the U.S. for that transition period. But maybe you see an opportunity in some of these European defense makers.
And when we're looking at these tariffs, and then we reposted a bit on trade restrictions and tariffs and how the U.S. is actually at the bottom, and I think that gets underplayed. That we're actually the freest of all traders. So coming up with tariffs, is kind of meeting the rest of the world. And the idea is, do we use that as a cudgel to try to lower the other tariffs, right, into our trading partners? But I know there's been some progress. How do we see the last week in terms of tariffs, people coming to the table, people willing to make concessions? Where do you fall on that in terms of what's happened this last week?
Well, again, talking is better than not talking. And right now there's a lot of talking, which I think is contributing to this uncertainty, which is why the administration can't tell you what they're going to do, because that's going to depend very much on how these other countries respond. And I guess the encouraging news that I saw was Europe sort of agreeing to postpone their responses to allow these conversations to move forward. To me, that signals some progress. I think you're right to point out, too, that most of the commentary, I think, is focused on the idea that the U.S. is going to have to raise the rates to match the level that other countries are imposing us. I think a more optimistic, perhaps realistic case may be that other countries decide to reduce their tariff barriers. I think that's a potential for upside surprise that day. And if we can expand market access for some U.S. companies in the process, I think that's going to be encouraging. But even just knowing what the rates are going to be announced at, I think will provide some at least additional certainty, hopefully moving forward. I think going to watch is what that effective date is going to be. It's possible that they could take effect, April 2nd. It's possible that there could be additional time to allow some of these negotiations to move forward. So, in my opinion, I think I would place more, maybe I'm just being optimistic, hope that other countries will reduce their barriers as opposed to us necessarily having to raise ours to their level.
Yeah, it's interesting. I've been doing this a long time, and actually kind of baptism by hellfire. I got in the business, was in it for less than a year when the first Gulf War started, and we had that line in the sand, right? I mean, literal line in the sand with.
You're that young?
I know. Can you believe it? Hey, 35 years ago and 35 pounds ago. That's what that's how I think about it.
I thought you started in the business during the Volcker disinflation.
Oh, you're cruel. I knew about the business. I knew about the business then. Yeah. No, I was on the playground at the time. That was the 70s. I do remember gas lines for sure, and the shortage. That was I am a child of the 70s. There's no doubt about it. But getting back to this, the the one thing that really jumped out to me was, we had that date, and I don't remember when it was. I thought it was sometime in January. And if you're not out by then we're going to come in and get you. And the date kind of came and went, and the missiles started flying or the bombs started dropping, and the market just ripped. Right? I mean, completely different than what kind of everybody expected. And as I've kind of progressed through this business, I always find that deadlines are interesting because the worst case scenario seems to be played into the market ahead of the deadline. Deadline happens, people freak out, but it's actually this relief. It's almost like a diagnosis in healthcare, right? Like you're waiting for the test to come back. You're waiting for the test to come back. You're like, oh my God, what's gonna happen? And almost regardless of what the test says, you're like, okay, like let's fight this thing. Let's do that. Like you have a game plan. You the waiting's the hardest part, right? I mean, as the Tom Petty song alludes to. And so I wonder if that's going to be the case with tariffs. If this April 2nd deadline, there's some crazy going on here too. So I know that deadlines don't mean a whole lot to this administration necessarily, but in terms of the way it historically works with the markets, a lot of times you end up with the worst case scenario already being priced in. So speaking of scenarios, Neil, we have the FOMC was this week. What did you glean from that? Any changes? More dovish tone, I think you were considering?
Well, I think it's really just about what was relative to market expectations, right? I think that's really the way we think about it. So it was dovish in the sense that they revised up their outlook for inflation, and despite that, they're still signaling cuts this year, right? So I think that's what was notable, and that's what the market latched onto. But I do think at the end of the day, you're talking about a Fed that's essentially waiting for permission from the economic data before they do anything. So, that part of it is not encouraging, but, that's kind of where we were at even before the March FOMC meeting. So basically, you need to see growth deteriorate, and then the Fed will come in and ease policy. I would just say, I think for me, the takeaway was more, political than anything else, because remember that equity markets rallied after the meeting. And I think that that's important, because that means that the Trump administration cannot scapegoat Powell as the reason for why things are selling off here. That's a very stark contrast to where we were in 2018, when Powell basically tanked the market with his long way from neutral rhetoric, if you recall. It's a lot more challenging for the administration to do that this time around. And so in some respects, the ball is back in Trump's court. It's going to be more difficult for them to lay blame at the Fed when the markets are rising, whenever the Fed speaks. Harder for them to do it than it was back in 2018, 2019. So I thought that bit of it was interesting. But look, I mean, the Fed is basically, they moved their forecasts in a stagflationary direction, right? Growth is weaker, inflation is higher, but they're still signaling rate cuts. And I think that's what the markets latched onto. I mean, Powell even dusted off the transitory, right? I mean, the inflation tariffs are a transitory shock, essentially. And again, that's sort of another nod in the dovish direction. I mean, I thought it was modestly dovish, not overwhelmingly so. But I do think that now that the Fed is kind of behind us, it's going to be more important for people to focus on what the growth outlook at the moment is.
And in terms of cuts, you're still in the two cuts this year, and when do you think they start?
That's where the market is. I mean, I think they'll end up doing more than that, because I think the economy is a lot weaker than they think, and that means I think unemployment is going to be higher than they think, or their forecast for the end of the year will be achieved sooner than they think. There's not a lot to like about the economy. I do think the labor market is kind of in frog boiling in a pot territory. I mean, if you look at continuing claims, they're rising about 5% against last year. In non-seasonally adjusted terms, there could be some seasonal quirks in the data post-COVID, so that's why we're looking at it year over year. But that basically means that sometime later you could see a steeper rise in seasonally adjusted claims. Home builders, you saw that earnings from Lennar. I mean, home builders are probably doing a little bit too much. in terms of construction activity. So construction is probably going to slow down. I think the big news for me this week was state and local governments. Bloomberg reporting a doomsday scenario for the future of Chicago's transit system with a $770 million budget deficit. And earlier in the week, Los Angeles Times reporting LA City facing a budget shortfall of nearly $1 billion, making layoffs, quote, nearly inevitable. You can't blame that on Doge. And so, just sort of go down the list. I mean, consumer spending likely slowing alongside the labor markets, housing likely sluggish, state and local governments weighing on GDP growth. And despite all that weaker growth, what is everyone worried about? We just did a whole swing on the West Coast for seeing our clients. Everyone's concerned about sticky inflation. That was, for the most part. And they think we're out to lunch with our inflation views. But I would just point out the things that people were worrying about are looking at the margin a little better. I mean, no one's talking about egg prices. I wonder why. Gas prices have moderated somewhat. Used car prices had been a push for inflation. But with auto loan delinquencies going up and potentially auto repossessions going up, you may be seeing more supply hitting the used car market than people thought. But over the last 6 months, the Manheim Used Vehicle Value Index, which is a measure of wholesale auction prices, that fell about 2% at an annual rate. During that time, CPI has been running a lot firmer. So there's room for CPI used car prices to weigh on push down the inflation numbers. So I just think that everyone's worried about this inflation issue because of tariffs. I mean, I get it. But tariffs increase cost, right? It remains to be seen how much consumers eat of that cost. It may not be as much as people expect. And so if that's the case, you are setting yourself up for kind of maybe better inflation news than people think in the spring. And if that's the case, I think that accelerates the path to additional rate cuts.
Right. What strikes me about tariffs that people don't talk about is, kind of the elasticity problem, right? If you've got 10 things to choose from and one of those things goes up in price because of tariffs, then you're just going to choose the other ones. As much as anything, it's an impact on quality, right? Like it's you might choose an inferior good based on the price because you're not getting the same quality within your decision tree. The other thing that's interesting is people don't talk about, well, what about these tariffs that we have in Argentina, the UK, China, etc. Like what's going on there for their inflation? I mean, is that inflationary for them?
Well, you bring up Argentina. I think, we don't know yet how the markets will respond if we get news announcements of other countries lowering their trade barriers. I mean, remember that, during his confirmation testimony, Secretary Bessent talked about escalating to de-escalate. So we're in the escalation part of this, and we need to see if there's a sort of light at the other end of the tunnel, if there's a de-escalation. So that remains to be seen. So we'll see. We're kind of waiting. And this is what the administration asked for. I mean, I think it was Trump that said not too long ago, you have to bear with me a little bit. So the transition, so we'll see. I mean, if it's just putting on tariffs for the sake of putting on tariffs, obviously that would be not good for the market. But if the goal is to shine a light on other countries to ultimately get to an outcome of free trade, then that could be very good for the markets. I mean, we'll see. I mean, it would. I will say. I mean, I am somewhat skeptical because if there's been one uniform line of thought from Donald Trump throughout his long public life, it is protectionism. I mean, everyone knows that kind of that interview he did with Oprah, where he talked about how the Japanese are knocking the hell out of our companies, and basically, giving a sermon on protectionism. I mean, that's he's been thinking that way forever, right?
Right.
So if it's trying to kind of get to a free trade outcome later, I mean, okay, but that would be somewhat not in line with his thinking on the issue for a lot. I mean, he's a protectionist. He's always been one.
If you're gonna make an omelet, you got to break some eggs. The question is, are you really making an omelet? Right. That's how we're looking there. Talk about existing home sales, permits, starts, kind of that sequencing. Home builders are on their butts, to say the least. They all look the same, by the way. So this is a macro, big picture issue. This isn't about Lennar versus Toll Brothers versus Meritage. They all look exactly the same from a chart perspective. But you had a post about existing home sales, closed contracts, pending homes, etc. Kind of what's that lineage, and what is that saying about home building?
Well, so remember, existing home sales represent closed deals. So pending home sales represent signed contracts. So signed contracts lead closed contracts, obviously. And so, I would just caution people in not reading too much into the existing home sales data, because pending home sales are actually running at cycle lows. So you kind of still need to see. I mean, you probably will see more weakness in existing home sales. So just because it rose in February, I mean, don't think that that's kind of the start of a new trend. The likelihood is that you get a reversal in closed contracts and existing home sales as we go into the second quarter, and that's going to weigh on broker commissions and the like, and in turn residential investment. I think home builders are doing too much. I mean, single family starts have generally been going up at a time when builder sentiment's weakening and unsold inventory remains high. So I think it's more important for builders to kind of focus on what they've already made as opposed to making new units. So I'd expect construction activity to moderate. And, certainly the Lennar earnings, I mean, they guided down, on orders and so forth. So I think the margin guidance was also down, but, you can see for yourself what the stock is doing, and it's not good. That's a sign that residential investment is not going to be strong going forward. And, you can blame any of that on, if you want, on tariffs and all this, but ultimately that's a sign that credit and the Fed are too tight. Okay. And that's really what that's about, in my opinion.
Well, and that was weakening, well before the administration, right? Home builders and semiconductors started really coming off in late summer, early fall. So this is not a, recency bias thing. This is
and despite the Fed cutting, which is
right.
I think more ominous, right? I mean, back in late 2022, home builders were outperforming despite Fed hikes. Now they're underperforming despite Fed cuts. I mean, draw your own conclusions.
Yeah. Steve, let's get you back in the fold here. Did Schumer commit political suicide? Obviously there's a lot of finger pointing and blame game and kind of capitulation on the part of the Democrats. What's happening inside the Beltway in terms of people's thoughts around? Was it politically inevitable, or was that a bad policy move on his part?
Well, again, to be fair to Schumer, his options are bad or worse. I think we talked last week about maybe he was raising hopes that they were going to dig in more for a fight. If that was the case, he didn't plan to follow through on it, and that was probably a miscalculation on his part. But he's not the only one to do this. I mean, you'll recall that Mitch McConnell threatened to shut down over the debt limit and then acquiesced. And when he did that, he sort of forced his leadership team to sort of take difficult votes to avoid default on the debt limit. I mean, in the end, Schumer had to do that for the government funding. I think the thing to watch moving forward, given the progressive pushback against him, is how is this going to impact the debt limit? Because Republicans have attached that to the reconciliation package. Very optimistically, they're hoping to try to move that by May. If that starts to slip, and history suggests that timeline will, they're going to have to pass a standalone bill that addresses the debt limit, and that's going to need 60 votes in the Senate, which is where Schumer comes in. He's going to be under a lot of political pressure to demand a lot of concessions there and sort of get a win after this most recent situation. I think that is a potential to create a lot of volatility around that. And that's not something the Trump administration is going to need at that point. So I think that's sort of how I think about it. And then look, the government's funded through September 30th. That's the end of this fiscal year. They're going to go over this, revisit this situation all over again at that point. And not to mention that Republicans are now marking the fiscal year 26 bills. That new fiscal year will begin October 1st, and they want to include some of the DOGE cuts. So again, needing 60 votes in the Senate, there's going to be a lot of political pressure on Schumer to resist. And that should be understood because they spent a lot of time, they being the Democrats, criticizing Trump, saying he's an existential threat. Well, if you do that and then you sort of signal that we're just going to continue business as usual, I understand why sort of the progressives are upset.
Yeah, certainly it was a no-win situation for Schumer. I feel for him, and probably from a leverage standpoint, you kind of give the keys to the kingdom if you shut the government down, right? And the executive branch has the power to determine who's open, who's not, and what actually is needed, what's not needed. Maybe the optics are bad, but certainly the political reality seems to be.
The future of the Democratic Party. You know who the future of the Democratic Party is? I'm going to say
AOC.
Ezra Klein and Derek Thompson. Honest to God, you see them making the circuit on this whole abundance agenda. I mean, I think it's kind of interesting. Like, they're basically talking about how, tight regulatory policies keeping, cities and states and like Democratic enclaves from building enough. It's like, well, I don't know. I mean, shouldn't you look at Texas then? I mean, their housing costs are down, and I don't know. Last I checked, that was a red state. But anyway, I mean, they're kind of. I think they're screaming into the wind at the wrong side. That's not the side that's receptive to those ideas. But
right.
I get what they're trying to do, but it just, to me, like I think if they want to go in that direction, I mean, I'm open to it, but it's to me it's a tall lift. Maybe Shapiro in Pennsylvania is the one that can kind of put that into action on that side of the aisle.
He certainly is reasonable and well spoken and a. I mean, if you were to ask me who to pick as the leader for the next decade out of that, I would certainly go with Shapiro on that.
The challenge for him is going to be, though, is how do you get through a Democratic primary when the electorate for there is very progressive? I agree that he'd be an attractive general election candidate, and the question is going to be, how does he survive that primary process? And look, there's talks now where Democrats are being compared to Republicans in 2010 in this Tea Party, where you sort of have this youth movement of more progressive members and rising through the ranks here, and they're going to challenge the status quo. So, Democrats are at a decision point as to which way they want to go, and I think they're witnessing sort of how they're wrestling through that.
We talked about the filibuster before, and I think the Harry Reid's decision on that whole mess really created this polarization, right? Because the filibuster forced you into the middle, right? It forced good policy. It forced you to get away from the fringes, and it's been a mess ever since.
Well, in particular, in more recent context, I would say that's contributing to what we're seeing here with the judges. You obviously have the Trump administration trying to test the limits of executive authority, and there's this question now of what is the judiciary's role in this? And to your point before, Harry Reid broke the filibuster for judicial appointments. Before they needed 60 votes, therefore judges were viewed as less partisan. Now, both sides are sort of stacking their respective decks with as many partisan judges as they can, and you have this sort of issue of jurisdiction shopping. And I think to your point, the country suffered as a result.
Yeah, I mean, when policies are around for 200 years, it's usually because they're good, not because they're bad. To throw them out the window is just short-sighted. Let's talk a little bit about transports, because transports broke, and from a Dow theory perspective, the idea around Dow theory was that the Dow Jones Industrial Averages, and this is really taking it back, 100 years, should be in line with the transportation averages, right? If you're going to make stuff, you got to ship stuff. And so it doesn't make any sense that the shipping companies, the rails back in the day, would be weak while the industrials would be strong. There's kind of a disconnect there, and that was seen as as being bearish. And there's a whole cottage industry that still is I don't know if they're thriving, but still in existence around the Dow theory. We've tested the Dow theory. The Dow theory was actually really good up until about 1950, and since 1950, it's been, I want to say really bad, but it's been essentially not worth its salt. So we're not really big advocates of the Dow theory. I think it's interesting, but it doesn't really hold up to the math and the philosophical underpinnings that it once did. What's interesting is that we are seeing negative trends in the transportation names, mostly out of the cargo ground transportation names. So those would be the truckers. Actually, believe it or not, Lyft and Uber fall into that as well. But we're seeing weakness there. We're seeing weakness in the rails. Really, the best area within transport seems to be in the airline side of the ledger, with a lot of oversold conditions. But I bring it up because we did get a dark cross, that's the 50-day crossing below the 200-day on transports. At the same time, and we put this on X, on Twitter, we're seeing a seller's frenzy in the option work. And so those two things, are in stark contrast. You've got a negative trend that's developed, but at the same time, you've got sentiment, which is overly bearish. They can coexist. And in fact, the way to think about it, or at least the way that we think about it, is sentiment tends to be a shorter term mechanism. So a lot of kind of the frenzy, a lot of seller's frenzy taking place probably leads to a pretty good bounce there, but within the context of an overall deteriorating picture and an overall weaker picture. So that's one thing to keep in mind. Again, the best area within transports, as we see it, are the airlines, and I wouldn't read too much into the Dow theory. It has fissured at best here over the last several decades. Well, let's bring in our own Harry Chen to discuss or ask the question for this week's mailbag. Good morning, Harry.
Good morning, Jeff. Good morning, everybody. So today we have the mailbag question from Mr. BC Guy 2010. And his question is, you highlighted some desk crosses. Are those bullish or bearish crosses? Do they need to have both moving averages running in the same direction? TYIA. Thank you.
Thank you in advance is what I think that TYIA stands for. So BC Guy 2010, we highlighted some death crosses. Are those bullish or bearish? We don't call them death crosses because they take on kind of their own marketing on that. They're bearish. We call them dark crosses. So the 50-day moves below the 200-day moving average. It's a sign of trend. If you're a trend follower, that's important. In fact, a good important point here is NVIDIA yesterday actually had a dark cross. So the 50-day moving average crossed beneath the 200-day moving average. I'll give you some statistics because I think they're important. We're less interested in the slope of the moving averages. We didn't really find that there's much differentiation there. So we're not big advocates of making sure that the moving averages are aligned in terms of their slope, right? Both sloping downwards. But let me give you some stats around death crosses or dark crosses versus golden crosses. If you look at the alpha generation in individual names, this takes it all the way back to 1957. So alpha is your returns above and beyond the risk-adjusted expectations of those returns, right? So it's capturing more return than you should given the volatility of the risk that you're taking. So alpha is a good thing. You want more alpha in a portfolio. What we found was that when the 50-day moving average is above the 200-day moving average on individual securities daily, going back to 1957, your alpha generation in those names is about 75 basis points positive. Now, you're not going to make the cover of Forbes, hitting 75 basis points of alpha generation. But I would say, go look at almost any mutual fund and you're not going to find positive alpha. So it is certainly a benchmark. Having positive alpha is good news, not bad news. what was interesting is when the 50-day was below the 200-day moving average, we actually found that the alpha generation was negative to the tune of almost 100 basis points. So if you think about that differential, you're talking about roughly 175 basis point differential in alpha. That is huge in terms of the market. So one of the things that we always suggest, just as a first check, is only own, particularly in size, only own names where the 50 days above the 200-day, i.e. it's already gone through a golden cross, because your probability of generating positive alpha is substantially higher than it is if the security has the 50-day below the 200-day moving average. So dark crosses are bearish, golden crosses are bullish. They tend to be regimes in which you can differentiate alpha over a period of time. So thank you for that question. BC Guy 2010 hat is coming your way. Steve, what is on the docket next week in DC?
Well, I'd point out that Congress is returning for sort of a 3-week sprint here for another 2-week recess period. And now that the government is funded through the end of the fiscal year, the end of September, Republicans are going to pivot back to the reconciliation package. I think really the thing to watch in the near term is going to be the Senate Republicans' conversation, Senate parliamentarian Elizabeth McDonough. She was appointed to the position by former Senate Majority Leader Harry Reid, Democrat from Nevada, and they're trying to get a sense of what's going to comply with the Byrd Rule, and in particular, what budget baseline we can use. And traditionally, it's the current law, and that's important because the current law shows that many provisions in the TCJA 2017 tax bill are going to expire at the end of the year. Therefore, if you want to extend them over 10 years, you have to account for the cost, and that's roughly $4.5 trillion. That's the traditional method. Republicans are hoping to use a current policy baseline, which essentially says that it's the current policy. Therefore, if you extend it, there's no need to add additional costs. There goes that $4.5 trillion score that is going to prevent Republicans from having to make difficult decisions on spending cuts. Now, even if McDonough allows this, and again, for skepticism given her background, it's not clear that fiscal conservatives are going to be on board because they sort of recognize it as an accounting gimmick. And even if Republicans are able to coalesce around that, if they proceed with this proposal, what's the reaction of the bond market going to be? Are we going to see the bond vigilante sort of reject that? So I think that's why it's pretty weedy. But when you think about the big term implications for not only the scope and scale of the package, its likelihood for passage, and what it means to markets, that's why I think it's important to watch moving forward. And that'll be over the next few weeks.
Got it. Neil, next week. I feel like it's been quiet on the economic front, not only this week, but I think next week's pretty quiet too, right?
I mean, we got a lot of second and third tier indicators next week. So new home sales will be one that we'll be watching closely. And then consumer confidence is out for March. So what we know about sentiment, given the drop in equity prices, sentiment is coming under some pressure. The Conference Board number tends to be more sensitive to labor market conditions than its University of Michigan counterpart. And so we'll be keeping an eye on what consumers are saying about the labor markets. That labor differential sub-index in the Conference Board survey is sort of a useful tell on the kind of trajectory for unemployment. And then we do get durable goods. If uncertainty is weighing on business investment, you'd expect to see it there. And then finally, core PCE is released at the end of the week next week. It's going to come in, too high for comfort, but I do think that we're probably going to get better news in front of us after this February print. So lots to chew on, but nothing like no first-year economic data coming out.
Yeah. Do you think between now and June, do you think we have a substantial miss in payrolls?
I think it's possible. Yeah, absolutely. Why not? I mean, like I said, we're in frog boiling territory. I mean, the fact that recruiting intensity is very low, the hiring rate is very, very low. It wouldn't really take much in the way of layoffs to kind of get you a spooky jobs number. So, the issue is, does that weaker payroll number translate into higher unemployment? And my sense is that it probably will. And so, the Fed is at 4.4% unemployment by year end, like that's their Q4 estimate. I wouldn't be surprised to see us close to that, by the middle of the year. So let's see.
Yeah. Well, certainly, if we start to see that with improved inflation data, that starts to move our market cycle clock back into a really bullish zone, and that's the zone the Fed usually is cutting. So that could be a big surprise for the bears that are out there. And that's what we're watching, right? Sentiment is, I'd say, 75, 80% there in terms of looking for what we want to see near some type of tactical low. We're not yet seeing it in some of the put call data that we like to see, which is a pretty good way to triangulate within hours and days. If we're near some type of tactical low, we're not seeing it in some of our capitulation indicators. But I would say from a wholesale perspective, what's going on in credit, what's going on with financials, what's taking place in the policy uncertainty, the oversold condition of beta, we think that we've got a good tactical low in place and likely to visit the 50-day moving average between here and sometime in the summer. So certainly put us more in the optimistic camp. There are a few things that could still happen, not from a narrative perspective, but from a technical side where, we start to see risk reduction. And again, that swelling of put calls, we'd love to see that, but that's going to require a retest. So I think we're in a pretty good spot here, frankly, to be bulls going into the spring. So we'll continue to watch that. Join us again. Sorry, that's not right. Join us again next week when we'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and subscribe to our YouTube channel if you want to see some of the charts that we had in today, or you want to just follow along with our production crew here. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Babbitt.
We'll see you.